I wanted to start a little bit in terms of overall venture capital, the asset class, and how we think about investing it today, right? And how does it fit into kind of a fully diversified program? Well, institutional investors have been investing in this space for decades and decades. It's pretty relatively new for a lot of RIAs in the area and advisors. And I just want to get a show of hands, like how many people right now are investing in venture capital for their clients today? Okay. And how many are considering starting to incorporate that into their portfolio program? Okay. All right. Well, just kind of to kick things off, Eric, I want to start with you. Just want to talk about the venture capital asset class in general and why it's so unique compared to some of the other alternatives out there and some of the other options that clients have to invest in.
Yeah, so I think at a very fundamental level, venture provides some interesting exposure to the types of companies that, number one, these are early stage companies. There are things in space tech and AI and deep tech. And that type of exposure, that type of innovation is generally very hard to find in more mature companies in the public markets, right? So some of the allure is the fact that you're kind of investing in the next Facebook, the next Uber, the next SpaceX. And if you look at it from that fundamental level, then it's an interesting component to be additive to a portfolio that doesn't have that type of innovative exposure.
Yep. No, thank you. That's helpful. Yeah, go ahead, please.
Jump on that, because there's one additional thing which is just a recent trend in the last 10, 15 years, which is that companies are staying private longer. So if you think about all the growth associated with a company, that could be a high growth company from day one. It used to be that companies spent 4 to 6 years before going public, and now they're spending on average 10 to 12. And so a much greater proportion of company growth is now being captured in the private markets by VC-backed companies.
Yep. And I think that's an extremely important point, and I want to touch on that. I think that trying to understand how to access these types of companies before they even get to the public markets, in some cases may never get to the public markets, right? You see so much capital creation being happening kind of in the private markets. How do folks kind of tap into that? And the strong venture capital returns that we've seen that's come along with that growth. But turning a little bit to, I want to kind of turn a little bit to how do advisors and more retail-oriented clients start to access this type of asset class? I mean, I think when you think historically, it's really been limited more to institutional investors, really due to a number of reasons, whether it's high minimums, difficulty accessing these top-tier capacity-constrained managers. What are some of the challenges that you've seen in the RIA space in terms of being able to access this type of asset class?
I think there are plenty of challenges, but I actually think Eric should answer the top of the funnel questions related to identification and discovery, because Vested is more the execution arm when you're ready.
Yep.
So.
Yeah, so I think the good news is, venture, we hear this terminology, venture is becoming more mainstream. And a lot of that credit goes to things like crowdfunding platforms or an organization like Angelus, which is syndicating, nearly 3,000 to 4,000 deals a year that has some sort of vetting behind it in terms of a lead bringing that to the platform and offering it to accredited investors. So the accessibility has greatly increased over the last handful of years, and I think that's what's promoting the conversation. Gosh, this is maybe something more than that little pocket of gambling money that you would just throw a few $1,000s into, right? So I think those platform approaches, the regulatory components of crowdfunding, have created demand, and I think naturally that's why clients are asking their advisors, how do I participate?
Sure. They want to be part of the conversation, right?
Absolutely.
Have that exposure.
Yeah, but there are a ton of difficulties to participating and not having it feel
the downside, right?
Yeah. Let's break it down, right? I think it's important to touch on.
Well, so you can participate in an individual venture-backed company. It's unlikely that an RIA or their clients are ever going to convince the CEO of a venture-backed company to let this RIA and their clients lead a new round. So primary funding at the individual company level is probably out. You can go to the secondary markets, such as Forge Global or EquityZen or NASDAQ private markets, and buy some shares that are being sold by an executive that might need some liquidity, as an example. But then you're just exposing yourself to one company, and this is still the venture asset class. These companies are pretty immature. That company could go to 100x. It could also go to 0, and that, to me, feels like gambling no matter how you cut it. You can start investing in VC managers. And Eric's platform is what helps you understand who's out there and how to think about investing in them. We can come back to vested at the end. I think the VC manager's exposure type is something where you have to be very thoughtful about getting into it, because although the median venture returns for the past 25 years have been pretty high, no one manager is going to be right there, and so you need to do a ton of diligence. So I'll turn it over to Eric to kind of help think about exposure there, and then I'll come back to vested at the end.
I think the concept of getting good access is still very much a challenge, right? And as somebody who has been investing in venture capital for 10 years, absolutely there is dispersion in terms of the ability to capture the outlier returns, right? So if you think about first and second quartile returns versus the bottom quartile, I mean, that is why you look for alpha, and that's why you invest in venture capital. And we talked about the fact that accessibility is easier, but good access is still very, very hard, right? And some of it comes back to what Dave said, is like, if you're a founder or you're in Silicon Valley, you just deploy capital. Like, you don't want to worry about, do I have to serve at this family office, or I don't want to talk to this individual. But this is really what I think is the platform fintech component of why new companies are getting created, because there has to be a barrier, there has to be a level, a buffer to help with things like reporting, diligence, portfolio construction, all of those traditional institutional tools that you need to be able to bring an asset class like venture needs to be in place before we even talk about like how, right? How to actually get into these deals and these funds.
So
Sure. And just kind of expanding on that a little bit, right? I mean, when you think about the fact that dispersion is so great, you look at different asset classes, say in the public markets, right? When you look at dispersion between one manager versus another, it tends to be much tighter of a band. In the private market space, the dispersion is massive between the top performers and the bottom performers.
I think somebody yesterday on this stage said you could drive a truck through it.
Yeah, I think that's fair.
Right.
I think that's definitely fair. And so how do folks get access to the type of diligence necessary to make the right decisions for clients, right? Because there are so many different managers out there, and to your point, it's concentrated, right? If you're investing in a VC manager, maybe you have exposure to 15 companies, and you're holding that exposure for quite a long time. How do you get comfortable that you're going to, kind of create a successful program for clients over the long term?
My view is that it's a very difficult thing, and the problem that Revere is helping to solve is a very hard problem and a very needed problem to solve. And as a result of that particular bent, the answer at Vested is to create an index fund. And so you don't need to find the single best manager and be sure that you're absolutely right. If you can get extremely broad exposure, very unconcentrated, if you can put on all of your positions at a substantial discount such that you can weather market environments like this one and maximally appreciate when the markets start going back up, that's what I would do. I think the index fund is the best gateway into VC because you're going to be tracking the market as broadly as you can.
Yeah.
But data, I mean, I think that's kind of the operative word here, right? It's remarkable. The leading investment consultant who services kind of the venture asset class, they release an annual benchmarking report. And on a vintage year cohort level, their data set is somewhere between 50 and 80 funds. So if you think about 50 and 80 funds being the barometer for the performance of an asset class like venture relative to, there's 4,000 or 5,000 total funds. And yet you've got billions of dollars looking at that data set and saying, this is why we do venture. So that's where I think there's a disconnect, right? There's not enough data. Because I think if you had more data, you would, number one, be able to measure the dispersion better. And number two, if you think about late stage venture, it's a very different risk return profile than early stage venture, right? And to kind of put everything against the backdrop of this is all a venture and this is the performance and this is why you should invest or not invest, I think is completely misguided.
Sure.
Right? So this is why it still really comes down to who can stand up and say, here's the data, it's standardized, it's transparent, and then you hold the fund managers accountable to refreshing that data.
Yeah. And I think this is really interesting because it's something that's been talked about for so long in the public markets, the passive versus active manager debate, right? And so thinking about it from a private market perspective and trying to capture potentially that median return, maybe you just want to get access to that asset class. You understand that you may not be in the top quartile, but you want exposure to that strong return stream that we've seen over time. Is it possible to do with an index-like approach?
It is possible. We're pioneering it at Vested. So there is a problem out in the world that allows us to pioneer the index-like approach, which is that the employees of VC-backed startups tend to be heavily compensated in stock options, but not understand until the day that they leave their job to go to the next job that they must exercise those stock options within 90 days of leaving, else they will lose them entirely. And this is a massive problem that you wouldn't know unless you've either been through it yourself or seen a friend go through it. But you have 90 days to come up with 60 grand that you don't have because you've been undercompensated in cash for the last 3 years. So the way that Vested builds its index fund is we help many, many employees do these small stock option exercises in exchange for a subset of the shares that they're exercising their way into. Each position is one new employee, one extra company, and we end up having an incredibly diversified, very unconcentrated portfolio. And it has the buffer of a pretty significant discount for each position that we're putting on. And that is the approach that we're taking to put together the index fund. Just to give you some quick numbers, no matter how conservative you are, at least 50% of stock options go abandoned. It's a $600 billion evaporation of value over the course of one business cycle. It's the biggest market that nobody knows about.
That's incredible.
Yeah.
Wow.
So if we were to put together, for example, a $100 million fund with an average employee ticket size of 100 grand, we would have 1,000 positions in the fund, and they would be from Series A all the way to Series F, tech, B2B, B2C, healthcare, materials and resources, all founding years represented.
And to be clear, this is something with a creative sort of model that is very different than, let's say, the endowment model where they're investing in kind of big brand name VCs, right? So I think that's what's fascinating about the VC asset class is there's so many different slices of ways you can participate, right? And that's kind of what is the opportunity. Whereas, you come from the institutional allocator background, it used to be, well, like, I have a team and we're going to invest in funds and we're going to stick with those funds, cycle in and cycle out, and over the long run, that's what generates the returns, right? But I think for the broader audience of investors, they may not want that, right?
No, and
Sure.
also, for the folks that are putting their clients into venture for the first time, the big brand name VCs that the institutional allocators get to pick up the phone and call are not picking up the call. There's not a $250,000 check that you're going to get to write into Andreessen Horowitz.
Right.
Yeah. Well, and I think to that point, too, right, when you think about an institutional venture capital or private equity program where you are, even to access one vintage of one fund, let's say it's a $5 or $10 million minimum to access that fund and that manager, right? And that doesn't even take into account vintage diversity, right? So I want to talk a little bit about how to access this through some of the innovation that we're talking about here today, right? Because when I think about it from my perspective, right, I think about investing in private equity and venture capital a little bit like investing in wine, right? Because for any particular vintage, right, depending on you.
Sure.
Yes. Well, that's how I think about it, right? My dad was a collector of wine. That's how I think about it, right? Any particular vintage of wine is going to be different depending on the environment in which it's grown, right? And then once it gets into the bottle, it's also very difficult to predict what that actual wine is going to taste like, right? And that's how I think about this, right? Making sure that you have exposure to various vintages because you are locked up for the long term, or is that how this works? Do you have liquidity? What does the liquidity profile look like in these types of vehicles?
I think you need to be investing in all of the available vintages over the course of time, and it needs to be programmatic. Just to give you an example from our own funds, our last vintage was deployed in October, November, December, January, February, at the absolute highs of the VC market. There was enough discount built into our purchases such that the fund is still up, so that's great. And the current fund is being deployed after the prices have started to correct. And that fund is up 6% in its first 2 months. And so if you're not there vintage to vintage, for no good reason, you're going to miss the cyclicality associated with like the overall returns of the asset class.
But I think specific to this audience, I think it's a lot of it is education, right? So normally when you're doing a rebalance of a portfolio, you get some liquidity and you're like, oh my gosh, I got to spend that right now this year, right? And you may deploy that or commit to a fund, and that fund is calling over, let's say, 2 or 3 years, which kind of has some built-in diversification into it. But it's sometimes not good enough. It's almost as if you need to say, if we're going to do venture, what does the deployment cycle look like over the next 4 years, right?
Mm-hmm.
So you do 25, 25, or you might say, hey, we're coming into a market right now where valuations are down and it's an attractive time. Maybe you put half of it in over the next 12 months and then you save kind of 2 more bites at the apple 2 or 3 years down the road. So I think that's a conversation which requires education to understand the asset class and communication between the advisor and client to really map that out, because that's quite different than how deployment into other asset classes might work.
Yeah, and I know from an allocator perspective, right, having those conversations with clients and introducing them to private equity, venture capital, and the idea of creating a long-term program is pretty foreign concept to a lot of folks that are just used to investing in a group of stocks today and seeing it on their balance sheet tomorrow, right? And then if they see an opportunity in fixed income, you sell your stocks and you buy fixed income, or you move around more nimbly. And having the illiquidity associated with investing in venture capital and private equity, right, is a foreign concept because, number one, it takes a long time to see your capital called, right? So you're sitting there, it's kind of boring, not a lot is happening, and then eventually you start to see the fruits of those investments down the road. In terms of liquidity for these vehicles, are they similar kind of drawdown lockup type structures, or how are they generally kind of?
There's so much innovation going on in the overall structuring of these vehicles that it's now no longer guaranteed to be a 10-year fund with 1 year optional, 2 1-year optional extensions. Our fund is a 5-year fund. Mm-hmm. We built our fund for registered investment advisors and their clients, and we were given some sage advice from a guy that runs a big RIA in New Jersey, which was people don't make 10-year plans. And so it's a 5-year fund. But there are a million different ways to structure things for the purposes of liquidity.
And some of it, I think, is, interval funds are making their way into private equity and venture, and 40 Act interval funds do have that redemption liquidity component, which I think should help with the conversation. It's not a perfect tool. Like, you can't just liquidate 50% of the portfolio. I mean, you just wouldn't have a market to even clear that. So I think some of it is going to be structural, regulatory in nature that will help produce or create some new vehicles to allow for some liquidity. But if you look at the capital stack, most of the capital going into venture capital is looking for later stage growth stage, right? So let's say you had built an index fund that was kind of indexed toward, early growth, and then 3 or 5 years in, you would want to sell that in the secondary markets. Yeah. There's actually so the capital is not the issue. It's really the vehicles and the structures and how can they be conducive to affecting that liquidity.
Yeah, that's right. Making sure that the fund itself is in fact saleable in 5 years.
Yeah, and do you see the demand for potentially more liquidity or more flexibility and structure having an effect on the potential total returns in the asset class? I mean, are you can't necessarily have your cake and eat it too. Are you giving anything up on the other side in order to create artificial liquidity potentially for investors that are looking for it?
I think yes at small scale and probably no at large scale. So if we were deploying $10 billion across all these $100,000 per employee deals, I can guarantee you that although I don't know which 3,000 are going to be liquid next year, 3,000 are going to be liquid next year, and you can predict liquidity pretty well. But at smaller scale, it's tougher.
And some of it is, if that's their top 2 questions is asking about liquidity, then maybe it's not a fit.
Yep.
Right? And I think that's got to be a really honest conversation. They may say, you know what, I have to have this, but if they keep worrying about, like, well, how would I sell it tomorrow? That's just not going to happen, right?
Yeah.
So, and again, it comes back to sort of the conversation with the advisor and education.
Well, I think about it more in the context of the interval fund structure, right? Okay. We're starting to see more and more of these types of structures for traditionally illiquid assets, right? And always the question is, okay, what is the trade-off in order to have that potential liquidity and to tap into a broader investor base, right?
One thing to think about on the interval fund structure, only because I've seen a couple of different versions of these, one way to guarantee liquidity is to not deploy all your capital in the first place, which has very clear trade-offs. I've seen an interval fund structure in the VC asset class that is holding 25% of its capital so that there is liquidity when people need liquidity, which kind of sucks for returns. So that's a good question to ask if you are looking at interval funds.
Or they're using lines of credit, right? I've seen that as well. Or levering up, right?
More scary, actually.
Yes, it is. Definitely. Wanted to talk a little bit more. You're talking a bit about different stages of venture and how to invest, right? Early stage, late stage. Can you talk a little bit about, and maybe Eric for you, how do you think about the risk-return trade-offs for these different asset classes? What are the types of returns we should be targeting? And how do you think about the risk associated with each of those different stages within venture?
Yeah, I would say in simple terms, I mean, generally early stage is pre-revenue companies, right? So these are before they have a lot of recurring revenue. And because they are pre-revenue, there is obviously higher risk, but the valuations are much lower, right? And at a company level, most venture capital funds are trying to underwrite to a 10 to 100x, right? So obviously the biggest variable there is like, what's the price I'm paying, and how long does it take to get to that exit price? So early stage venture
10 to 100x. That's a big. Speaking of driving a truck through it, that's pretty big.
Yeah, but I think early stage is the true kind of traditional definition of venture, which is like two people in a garage with an idea. That idea could turn into the next Apple, right? And that's why there is a lure to doing it. But by the same token, you wouldn't want all your eggs in the early stage basket for that particular reason. And so when you look at growth and late stage and some of the exposure you get through kind of the index, it's moving into revenue. It's got kind of market share. There's enterprise customers, right? So then you're now able to do some underwriting to that company. Of course, you're paying a higher valuation for it, but that's kind of the trade-off to it.
Sure. Yeah. More established business model, right? Actually recurring revenue potentially in place, right? You can underwrite to that.
I've also seen it be the case that I would say late D-stage companies and later were the ones whose valuations were bid up the most over the last 5 years.
The pre-IPO.
By a handful of VCs that recognize that these companies are effectively running themselves at this point and that you don't need to do the VC value add pitch and you can just write your check and get in. So I also think for that reason, early and mid-stage companies have a bunch more growth potential than the later stage companies that have been underwritten in the last few years.
Yeah, that's a really interesting point, I think, especially given all of the volatility that we're seeing right now in the public markets. Today was no exception of that volatility. And then I think when you're looking at the private markets, the IPO window really essentially being more or less closed at the moment, how does that affect the potential exit for some of these companies that had been raising later and later stages at higher valuations? I mean, are you seeing more venture debt being put on the balance sheet because they're afraid to invest in a new down round? Or what are you seeing in terms of opportunity set for a lot of these companies that are now potentially in a little bit of a tricky situation?
That specific question, yes.
Yeah.
There are a whole bunch of companies that are raising money and not doing it on a priced basis for the express purpose of avoiding the headline associated with a down round. Yep. The earlier and mid-stage companies, I haven't seen nearly as much of that behavior, mostly because they raised more money than they needed at great valuations when times are good, so all they're doing right now is tightening their belts.
Yep.
Yeah, and I think there are always buyers. It's always at what price, right? So, unlike certain existential issues that may happen in, like, let's say, the crypto or digital assets, right, where things, the money disappears. In venture, there's always capital on the sidelines, just waiting for what's a good price and what's the time horizon for realizing that investment. So I think there is a little bit of a buffer there that despite, the public markets and valuation multiples being tied to that, creating scarcity of capital, especially in the late stage, there's always going to be buyers, right? So it's just kind of rotation, if you will.
Yeah, and kind of digging into that a little bit more, given the fact that we've seen such a kind of change in compression in multiples in the public markets, what are you seeing, I think this question is for both of you, what are you seeing as opportunity right now in the venture space? Is this a good time to be investing in venture capital if you have dry powder on the sidelines?
Yes. There was a great piece that was put out at the beginning of the market carnage in May, June by iCapital, where they took a bunch of PitchBook data and Bloomberg data and kind of showed that vintage returns in down markets tend to be even better than the average vintage return. 2001, 2002, 2009 were all great. That's the market in which we're deploying right now.
Yeah.
There's
The old buy low, sell high adage.
well, there's a layer of nuance to that, because yes, the valuations are lower, but actually what has happened in this type of market is the marginal company in a hot market that would have got the next round of financing is not getting financed. So that company is either getting acquired, the engineers are going to leave and go to stronger companies, right? So behind the scenes, you have a lot of the rotation of human capital, human talent, moving away from that, like I call it, the marginal company in a hot market, where it's like, we can be number 3 and we'll still make a great return. Like in this rational market, they shouldn't exist. So it's not purely, so part of it is the valuation issue, and part of it is the quality of the supply is going to get that much better. So then if you are deploying capital into a smaller pool, it's just going to be naturally higher quality.
So that almost argues that, so if the number 3 marginal company is out, then there is a reason to pay a higher premium for the number 1 company in this. And are you seeing valuations in those types of businesses be sustained at these levels?
Not yet.
Not yet.
It's still a good time to buy across the board.
Yep. No, it's helpful. I want to turn a little bit to manager selection in general. And Eric, I wanted to ask you, I know that a lot of the work that you're doing at Revere is around emerging managers and creating more awareness around some of these new managers that are maybe building out their franchises. Can you talk a bit about the differences between investing in emerging managers versus more established big name managers, and what that kind of experience might be?
Yeah, I think the more established funds, by definition, are going to have some amount of track record for you to pour over and say, okay, well, I know here's the returns, and were they able to execute against the strategy? Did they do the follow-on rounds, right? So there's a comfort in knowing that they've been through that process and they can execute against that. For a lot of emerging managers, and these are generally fund 1, 2s, and 3s, their track record is going to take time to develop, right? So it is absolutely a different underwriting criteria. It's a little bit more qualitative in nature. You're looking at things like the strength of the team, right, and their operating backgrounds. How do they add value? You're assessing kind of their ability, or projecting their ability to run a fund. Actually, that I actually think is probably something that gets glossed over. Is like, you get excited by the pitch deck, and it's like, oh, this is the next great fund manager I want to put money in. But we spend a lot of time asking them about what's their reporting, compliance, is it audited, right? A lot of early stage funds are not audited. So I think there's some basic questions that are more appropriate to be asked for emerging managers, and that's where we spend a lot more time.
And are you generally seeing emerging managers be, a breakaway partner from an existing large firm, or how are these funds kind of coming to fruition?
A couple of buckets, right? So you have younger junior partners leaving a larger franchise because they get more of the economics. You have a lot of operator angels, right? So people who were successful operators, founders, did a little bit of angel investing as their kind of trial by fire, and now they're formally raising a fund. And then you also have, I would say, people who are very scientific or technical, right? If you think about the deep tech space, where by definition you have to have a very technical background, those type of scientists and engineers and technicians, they are now moving into the investment arena, right? Because they know that if they can back that company at the early stage, it's going to be tremendously successful. So generally, those are the 3 different buckets that we see within the emerging manager category.
And are you generally seeing folks investing across the board with a diversified group of managers, or focusing in specific areas? And I know, kind of a tangent to this too, I know a lot of our clients, they are interested in investing in their own private companies, or companies that they feel very strongly about. And so how are you seeing folks kind of build a diversified program? And I guess this is for you as well.
Well, I think it's a difficult and painstaking thing to do across managers, and it's got to be done very well. You got to make sure that you feel good about the managers and operationally good about the managers. You got to make sure that you are investing in a way where the strategies are not so significantly overlapping that you still end up crazy concentrated in a couple of different areas. So I think it's a tough thing to do well, and you got to be very thoughtful about it. And that's why Revere is doing such an important thing.
So think about it this way. It's like the shots on goal, right? So if your shots on goal are measured by the number of companies you have exposure to, what Dave might be doing with his index style, company level exposure, large number, you can actually replicate that by investing in funds, right? So if a typical venture capital fund is investing in 25 to 35 companies, with one relationship, with one vehicle, you get sort of built-in exposure, right? And then the question is, okay, well, how many managers do I need to get to, let's say there might be a magical kind of risk-return profile of like 400 or 500 companies, right? And again, that's a very kind of personal decision, because as you build diversification, you lower volatility, but then you are also potentially trading off some of that outlier return.
Yep. In addition to that, you have to think about the operational stuff, which is, especially for this audience, are the VC funds approved on the various custodial platforms that you guys use to put your clients into things? Are you ready with the software you need to manage 5 or 6 K1s?
It's a big question. Yeah, no, I mean, I think the operational headwinds associated with investing are not to be overlooked, right? And I think it's all about client education, helping clients understand what to expect on the forefront so they're comfortable participating for the longer term in VC. And to that end, I mean, when you think about, Dave, creating a successful program, right? Do you see it as sector-focused funds, or a more broad kind of sweeped approach in terms of manager exposure? Obviously, we talked a little bit about index versus active, right? You know, are there going to be specific indexes that are focused on sector exposures, whether it's healthcare or tech, you know, software as a service, et cetera? What is kind of the vision there?
So over the course of time, for sure. I mean, you can just look at public markets indexes and see how many ETFs now exist at the end of that cycle, and know that at some point we're gonna be able to slice and dice very finely.
Right.
So we're pioneering the index fund at the moment, which is tracking the asset class as a whole with a little bit of discount produced by the buffer, produced by the discount at which we're buying. Over the course of time, as we scale our deployment, we're going to have enough inventory to start creating tranches, and there will be the Sequoia index and the Series B index and the robotics index. And at that point, when you start having opinions on particular sectors that you want to be exposed to, you'll have the opportunity to. I do think, though, whether or not you're trying to track the market as a whole or have opinions on particular sectors or stages, you do need to be programmatic about it. So to go back to your vintage comment, there is nothing that you should be planning where you're not planning on doing it a handful of times over a period of time.
Yep, that's helpful.
And then, yeah, maybe to zoom to the fund manager level, because there are so many new funds being created, by definition, they have to have some level of differentiation, right? And so the sector specialists or the pre-seed focus fund, for them to even build a franchise, they have to come at it with some specialization. So that's why I think when you look at the opportunity set, you see a lot more specialized funds come to the market, which I think, again, there are trade-offs, right? You kind of have to evaluate whether they can just make good returns with the exposure that they're building. But it does give clients and advisors more choice, right, in the thematic kind of orientation of investing, which I think is obviously found its way in public markets. And it's only natural for somebody to say, hey, I just bought the ARK Invest, ETF, and where can I find that version for private markets? So I think it's a part of the conversation, but the execution of it is going to be very bespoke.
Yeah. Well, and I have one final question for you both before we turn it over to some of the audience questions, and a few of them are coming in now. But to end our session, I just want to ask you both, what do you think are going to be kind of the biggest themes coming out of, just kind of emerging out of all of this once everything is said and done and looking forward? Do you think this trend towards more transparency, more accessibility in this space will continue? And if so, what's your outlook?
For sure. The train has left the station. Everything is going to get more transparent and more accessible, and it's up to shops like ours to help bring that transparency and the accessibility. But just to give you an example, I mean, there's a few $1 trillion worth of cap stack in the venture asset class, US-based alone right now, and I think a few billion of those dollars currently trade on the secondary markets.
Wow.
And that's up from a few
Wow.
$100 million not
Wow.
too many years ago.
Wow, that's a really interesting statistic. Wow. What about you?
So, universally I find in my conversations, people are not asking like, oh, I want to do VC. Usually they're saying, oh, I want to do a clean tech fund, or I want to do an impact fund, or we have a question here about ESG. Usually there's some expression of a view, and then they naturally say, well, how do I do that in VC? Right? So this, I think, is going to be the trend because it allows for an easier onboard. Because people don't just say, hey, what's this VC thing? I want to have exposure. They usually say, oh, I ran into this company, or I met this fund manager, and they sound really interesting, and they happen to be a venture capital fund, right? So this psychology, this buying behavior, I think is very, very unique to venture, right? That is very different than public markets or even fixed income. And it's up to new platforms. It's up to us as the industry practitioners to really express that view and provide vehicles for people to participate.
Yeah. And that ties into one of our audience questions, which is really around accessibility for the space. And the final question, is it a good thing? Is it a good thing for the space in general as an asset class? Should we expect the same types of returns going forward? What does this look like?
It's interesting. I'll answer that question from the perspective of our employee customers who are helping. It's a phenomenal thing. It stinks to go work for a private company and get your paper lottery ticket as a piece of your compensation and then hope that one day it can be worth money. All of the liquidity will end up factoring all the way down to the employee level and making it so that you can actually take a job where the primary part of your compensation is stock and not wonder if that stock is ever going to be worth anything to you. So I think that's phenomenal.
I think dispersion of venture capital returns is going to persist. There's always going to be amazing, great venture capital funds, and obviously if you can catch them early on a fund 1 or 2 and they make it and escape velocity, you have allocation to a great franchise. And there's going to be some that after 1 or 2 funds, they don't exist, right? Because the performance is not going to be there, right? So if you go into the asset class understanding that there is dispersion, then I think it is part of the underwriting. It is part of the job to go and find the upper quartile, right, or the top 2 quartiles. And I think that's the justification on why you would want to do venture. So, so despite, I think more capital coming in, innovative models in terms of how we help with the onboarding, at the end of the day, it comes down to performance.
Yep. I couldn't agree more. And then we have one other question here from the audience, and I think you started to touch on this a little bit, but just about ESG, environmental, social governance responsibility. How is that permeating through the VC and PE space? Are you seeing this primarily through impact funds? Are you seeing this more at the manager level in terms of the types of companies they're investing in? Or is this really investor-driven?
Better question for Eric.
There's too many definitions.
It means something different to everyone, right?
And I think it's a way for people to create a label to say, for example, oh, I'm only going to do this type of investment, right? Because the problem is there's just too many choices, right? And if you don't have the benefit of like 10 years of track record to say, well, this is the one I'm going to go with, you have to create these labels. You have to create these buckets to say, oh, we're an impact fund or an ESG fund, or we're going to do something around diversity, equity, inclusion, right? These are all important components of how you can generate returns, right? There's studies on this. But the actual evaluation as an investor looking at all these different labels is very difficult. And there's no industry standardization. And I think a lot of that has to come from someone like the NVCA, the National Venture Capital Association, which is the governing regulatory body that helps kind of establish laws with SEC and things like that, guidelines. So I think it's going to require some of these industry bodies to stand up and say, this is how you measure ESG, right? Or if there's an impact angle, this is how you measure it, and then it gets widely adopted as the framework.
Thanks. That's helpful. Well, thank you both so much for being here. I don't know if we have any other questions from the audience, but I think we're just about at time. So, all right. Well, thank you both.
Thank you. Thank you, Nicole.
Take care.